All right, let's talk about IFRS S1. If you're with a small or medium-sized business, you might be looking at this new sustainability standard and thinking, how on earth are we supposed to do all this without a massive budget? Well, that's exactly what we're going to break down today. There are ways to make this manageable, and we're going to show you how.
Okay, so here's our game plan. First, we'll look at the reporting challenge head-on. Then, we'll get into the secret weapon for SMEs, this idea of proportionality. After that, we'll talk about what to do when numbers get fuzzy, how to handle metrics and targets, and finally, we'll walk through a super practical example to see it all in action.
Okay, let's kick things off by talking about the elephant in the room. We know what the main worry is for smaller companies when a big, new standard like this comes along.
So if you're the one in charge of preparing these reports at an SME, seeing IFRS S1 probably feels, well, a little overwhelming, right? It's a big standard. And trying to implement it when you're already stretched for time, people, and money, yeah, it can feel like a massive mountain to climb.
But here's the thing, and this is really important. The folks who created this standard, the ISSB, they totally get it. They knew this would be a heavy lift for some, so they actually built solutions right into the rules. Think of them as practical relief valves designed to make this whole thing doable for companies of all sizes.
So, what's this magic solution I'm talking about? It all boils down to one word: proportionality. Seriously, this concept is going to be your absolute lifeline as you work through IFRS S1.
You see this phrase, without undue cost or effort. You need to commit this to memory. It's the core of proportionality, and it pops up all over the standard. What it means, in plain English, is that nobody expects you to go on some crazy bank-breaking hunt for every last piece of data.
Okay, but what does undue cost or effort actually mean? Now, it's not a get-out-of-jail-free card. It's all about judgment. You have to look at your company's specific situation and weigh the cost of getting the data against how useful that data will actually be for investors. So think of it less as a loophole and more as a built-in reality check.
All right, let's move on to another tricky area. What do you do when you know a risk could hit your finances, but putting an exact number on it, well, it feels like trying to nail Jell-O to a wall? This is a super common problem, and a totally fair one. The good news is the standard has a plan for this. You're never, ever expected to just make up numbers when you're facing a ton of uncertainty.
Look, the preference is always for quantitative data, actual numbers, a single amount or a range. But, and this is a huge but, IFRS S1 gives you an out when it's just not practical. You can switch to qualitative information, that is, a description, if you can't pin down the exact financial effect. The uncertainty is just too high, or you just don't have the skills or resources to do it. See? That's proportionality at work again.
So here's the thought process you should follow. First, you try to get the numbers. Then you ask yourself, is the uncertainty just way too high here? Or do we honestly lack the resources to figure this out? If the answer to either of those is yes, then you don't have to provide a number. You switch to a qualitative description instead. The most important part, though, you have to explain why you made that choice. It's all about being transparent.
All right, let's shift gears and talk about metrics and targets. This is how you actually show the world what you're doing to manage all these risks and opportunities we've been discussing.
Now, for metrics, the standard is actually super practical. It's not asking you to create a bunch of brand new, complex measurements. You'll need to disclose any metrics required by other standards, sure. But a big piece of this is just telling people about the metrics you're already using inside your company to track performance and stay on top of things.
And when you do set a target, you have to give the full picture. It's kind of like a checklist for transparency. You need to say, what metric are you using? What's the target itself? What's the time frame? And what's your starting point? Answering these questions gives everyone the context they need to see how you're actually doing.
Okay, enough with the theory. Let's make this real. I'm going to walk you through a practical example, a situation that a lot of SMEs could easily find themselves in, so you can see exactly how all these principles come together.
So picture this. Your business depends on one key supplier for a critical component. But here's the problem. They're located in an area that's getting hit more and more by extreme weather. We're talking major floods, severe droughts, things that could shut down their operations completely.
So you absolutely know this is a big risk. But trying to calculate the precise financial fallout, like the exact dollar amount of sales you might lose, that's a whole other ballgame. You'd probably need to hire expensive consultants, pay for complex climate modeling. It's a huge, costly project.
And this is the moment of truth. You, as the preparer, have to ask,
For a company our size, does doing all that analysis count as undue cost or effort? This is exactly where you use that proportionality principle we've been talking about. It's a judgment call.
In this case, let's say the answer is yes. The SME looks at the situation and decides it just can't justify that cost and effort. So it makes the call to use the relief for measurement uncertainty and go with a qualitative disclosure instead.
And here's what that good compliant disclosure looks like, even without a hard number. First, you explain why you can't provide quantitative data. You say it's due to undue cost and effort. Second, you describe the risk and what it could do to your operations. And third, you point to the parts of your financial statements that would be affected, like your revenue or cost of goods sold. That is a perfectly acceptable and useful disclosure.
Okay, let's bring it all home. I want to quickly recap the main things you should remember when you start putting IFRS S1 into practice.
The biggest takeaway is this: IFRS S1 has flexibility built right in. It's not meant to be a crushing burden. The whole point is useful information, not making you spend a fortune on data collection. So always focus on what's reasonable and supportable for your company. Use that proportionality lifeline and the reliefs for uncertainty. They're there for a reason.
At the end of the day, this framework isn't just about more paperwork. It's about a smarter way to communicate your story. It gives you a way to be transparent that's actually manageable. So now that you have these tools, the real question is, what's the first sustainability risk you're going to assess using this approach?